Your trade shows zero commission, so who paid for it? It's a strange question, but the answer reveals a fundamental truth about modern markets. When the service is free, your order itself becomes the product. Let's follow one simple trade and see exactly who gets paid and how. You tap buy. The confirmation says zero commission. It feels like a free lunch, a modern miracle of finance. To understand how we got here, we have to go back to a single week that changed everything. On the 1st of October 2019, the brokerage giant Charles Schwab cut its online stock commissions to zero. The market was stunned. Within days, its biggest rivals, TD Ameritrade, E-Trade, and Fidelity, all matched the offer. An entire era of fees, the bedrock of the retail brokerage business for decades, simply evaporated in under a week. The button on your screen got free. But behind the button, the market's plumbing got busier and much more profitable. So what exactly pays for that free button? If you ask your broker, they'll point to two official promises: best execution and price improvement. These are regulatory requirements, and they sound great. But what do they mean in plain language? What are they improving on, and by how much? The benchmark for every trade is something called the NBBO. That stands for the National Best Bid and Offer. It's the highest price any buyer is publicly showing they'll pay, and the lowest price any seller is showing they'll take, across all public exchanges. Think of it as two official price tags for the same stock, facing each other with a small gap in between. Let's say the market for a stock is $10 by $10.01. The gap between the best bid and the best offer, the spread, is 1 penny. If your broker gets your order filled even a tiny microscopic hair better than that quote, it officially counts as price improvement. It can be printed on a report, and it looks like you won. The method matters more than the amount. Now, here is the mechanism that actually funds most free trades. It's called payment for order flow, or PFOF. Giant trading firms, known as wholesalers or market makers, pay retail brokers fractions of a cent per share to send them your order directly, instead of routing it to a public exchange like the New York Stock Exchange. This practice is legal in the United States, as long as it's disclosed. Brokers have to publish quarterly reports under an SEC rule called 606, showing where they send orders and what payments they get. If you read them, a few names show up over and over. Massive high-speed firms like Citadel Securities and Virtu Financial. Their business is internalizing retail order flow. Let's walk through a single trade. You decide to sell 300 shares of that stock, quoted at $10, by $10.01. It's a $3,000 order. You hit sell. Your zero-commission broker doesn't send your order to an exchange. It sends it straight to a wholesaler who pays them for it. The wholesaler buys the 300 shares from you at $10.50. That's half a penny better than the $10 public bid. On your 300 shares, you just got an extra $1.50. That tiny gain is your price improvement. The wholesaler now owns your shares. They immediately turn around and hedge their position, likely selling shares to an institutional buyer at or near the $10.01 public offer price. They capture the other half of the penny spread, another $1.50. Out of that profit, they pay your broker a rebate. Maybe it's 0.2 cents per share, so 60 cents for the order. Everyone got paid. And your trade never once touched a public stock exchange. There's a clever structural reason this works so well. A regulation called the sub-penny rule generally blocks exchanges from displaying quotes in fractions of a cent for stocks over $1. You can't publicly offer to buy at $10.50. But the rule allows trades to be executed in those tiny fractions. Wholesalers operate in that gap. They can fill your order internally at a price that is technically impossible to quote on a public exchange. That sub-penny fill is just enough to beat the public quote, generate price improvement for the report, and let the wholesaler keep the majority of the 1-cent spread. It's an advantage baked into the market structure. To a wholesaler, a retail market order isn't a random event. It's high-quality inventory. That's because, statistically, retail orders are considered uninformed. This isn't an insult. It means individual investors don't usually have secret information that will move the market in the next few milliseconds. Their orders arrive more or less randomly. In market jargon, this flow is non-toxic, making it very low risk to trade against and hedge. It's the perfect raw material for a high-volume, high-certainty business. The wholesaler's game is simple. Internalize the order, capture a reliable slice of the bid-ask spread, and hedge the risk instantly. The profit on any single trade is microscopic, but scale that across millions of orders every single day, and you have a multi-billion-dollar business built on the predictable patterns of retail traders. For the broker, this becomes a simple math problem. They can route your order to a public exchange, or they can route it to a wholesaler for a guaranteed payment. Typical PFOF rates for stocks are about 1 to 3/10 of a cent per share. For options, it can be 15 to 60 cents per contract. For a broker processing millions of trades a day, this is a river of nickels that adds up to a fortune. Those public routing reports show a market that is highly concentrated. It's common to see brokers sending more than 80 or even 90% of their marketable retail orders for a given stock to just 2 or 3 wholesalers. The flow follows the payment. This has fundamentally changed the shape of the market. Since 2020, it's been common for 40 to nearly 50% of all U.S. stock trading volume to happen off-exchange, in these dark venues. A huge portion of that is retail flow being matched internally by wholesalers. The result is that a very small club handles a very large portion of your trades. One major firm has at times reported handling around 40 to 50% of all U.S. retail equity volume. The next biggest holds another large double-digit share. It's an efficient system, but it's also a highly concentrated one. Here's the catch. You might get price improvement of 0.2 of a dollar per share and feel like you got a good deal, but you may have missed out on a better price that flashed on a public exchange for a fraction of a second. Or you might have gotten a much better fill at the midpoint, the price exactly between the bid and offer, if your order had been exposed to more competition. Wholesalers publish enormous figures, often in the billions of dollars, for the total price improvement they provide to investors annually. These numbers are correct by the specific definition of beating the public NBBO, but they don't capture the whole story of what the best possible economic outcome for every order might have been. Zero commission trading is a bundled service. Payment for order flow is just one revenue line. The others are just as important. The interest brokers earn on the uninvested cash sitting in your account, the interest they charge you for margin loans, and the fees they get from lending out your shares to short sellers. In fact, during quiet markets, the net interest income a broker earns on customer cash balances can be much, much larger than what they earn from PFOF. This is why some large brokers, like Fidelity, can offer zero commissions on stocks without accepting any payment for order flow for those trades. They lean heavily on those other revenue lines instead. For years, this was all deep market plumbing, invisible to the public. That changed in January of 2021. The meme stock phenomenon caused a massive surge in retail trading volume. Off-exchange prints spiked, and suddenly, the hidden pipes of market structure were headline news. The new scrutiny came with consequences. Just before the meme surge, in December 2020, the zero-commission pioneer Robinhood paid $65 million to settle SEC charges. The regulator claimed that from 2015 to 2018, the firm failed its duty of best execution, prioritizing its PFOF revenue over getting the best prices for customers. The SEC's order found that for many customers, the inferior prices they received on their trades added up to more than the commissions they had saved. It was a stark lesson. The incentive to maximize revenue from order flow can directly conflict with the duty to get the best outcome for the client, if the system isn't policed. Other countries have taken a harder line. The United Kingdom banned payment for order flow for retail orders all the way back in 2012. Their regulators decided the practice created an unavoidable conflict of interest that couldn't be managed with disclosure alone. It had to be eliminated. Several European jurisdictions have followed with restrictions, and a broader EU-level ban has been advancing. In the United States, PFOF remains legal, governed by duties of disclosure and best execution. The debate is fierce. Proponents argue it lowers costs for investors and enables zero commissions. Critics argue it creates conflicts, harms price discovery on public exchanges, and gives wholesalers an unfair advantage. Regulators have been listening. The SEC has proposed some of the biggest potential changes to U.S. market structure in decades. One key idea is a retail auction system, which would force wholesalers to compete directly against each other and against exchanges to fill an order. The goal, in theory, is to bring more competition and transparency to the pricing of retail trades. Once you see this mechanism, you see the pattern everywhere. A free front end with a monetized back end. Search engines did it with ads, social media did it with user data, and now retail trading does it with order flow. The product isn't the app. The product is the stream of activity that the app generates. Even public exchanges run a version of this. It's called the maker-taker model. They pay rebates to firms that make liquidity by posting a displayed quote, and they charge a fee to firms that take liquidity by trading against that quote. Different pipes, different names, same fundamental idea. Markets run on incentives, not slogans. So here is what it all means. In markets, the price you get is determined by where and how orders meet. When your trade is treated as inventory for someone else, the routing path matters just as much as the ticker symbol. The invention of zero commission didn't eliminate the cost of trading. It just changed who your counterparty is and hid the cost inside the spread. This entire system is built to serve one deep human impulse: the desire for an instant, free result. But in markets, there's a price for speed. The demand for immediate execution with a single tap is precisely what makes a retail order profitable inventory. A more patient order, like a limit order that waits for its price, is less predictable and less profitable to internalize. Market structure doesn't just enable speed, it monetizes it. The costs of trading never disappeared, they just moved. They now live in the spread, in opportunity cost, and in the market structure itself. If you appreciate having these hidden mechanics decoded, subscribe to the channel and drop a like. We stick to how the plumbing really works: bubbles, crashes, and all the forces that actually move prices. See you next time.